All right, so today was pretty crazy. We seen the stock market tank after Trump came out. He posted on Truth Social a fresh round of threats over to China and doubled down on tariffs. And just like that, the trade wars back. It has re-entered the chat. Hey, big head, how you doing? And then everybody ran not to click the like button, but they slammed sell on stocks. And we seen this stock market that just sold off. It had its worst day in months because what we've seen is that not only did it erase its entire week's gains, we've seen the Dow fall 1.9% in a day. The S&P, it sank 2.7%. The Nasdaq, it collapsed 3.6%. So worst day in months. And then we also seen this volatility index. It surged 32% on the VIX as this fear has finally returned for a spooky season as we enter into October. Happy Halloween, everybody. But I had to on Weeble here, you could watch me do this, how you gotta like make the price smaller so you could see exactly what happened. Once you get on this 30-minute time frame, well, when I got on, I had to zoom out because it just didn't all fit in the picture. So this was after weeks of record highs and more of recent celebration over this bull market's third birthday at turning 3 years old. And there's this painful reminder that the entire party got today, which is that geopolitical risk still rules the game. So let's talk about the largest story of the day, which was Trump announcing that he's moving to hit China with this additional 100% tariff on top of the existing 55% we already have in place, meaning virtually all Chinese imports, all worth about $440 billion as of last year, would be subject to these tariffs starting November 1st. And earlier this week, Beijing announced new restrictions on rare earth mineral exports, which those materials are super critical for the industries everybody's watching here in the US, like AI chips, electric vehicles, semiconductors, even planes. All of these industries are hot in the headlines these days. So this was Trump's way of retaliating against that. So in other words, both sides just weaponized the most essential parts of the global supply chain. So all of those talks and negotiations going on, it doesn't seem like it's been going well at all, and probably a waste of time. So, and Trump, he confirmed this in a way. He's canceled his meeting with Chinese President Xi Jinping, which was supposed to happen next week. And now after the two countries have spent months trying to de-escalate, like I said, it was probably just in vain. They completely wasted their time. But now we got this time window we need to watch between November 1st, which is when Trump's tariffs start, and December 1st, when the China's rare earth bans will finally kick in. So if we don't see a deal reached by then, we could see the trade war of 2018 start all over again. But this time we got a ton of layers to this cake. We got tariffs, we got inflation, we got the government shutdown already in motion, we got this deteriorating labor market. So have what you want. But the reaction was pretty immediate. So what I seen today is I just checked my phone. I'm at work. I just checked my phone real quick. Where's my phone at? And I just opened up Robinhood, and I'm like my eyes pop out of my head. So I stopped exactly what I'm doing, and I did some calls. I made some quick money real quick. But it just kept on going. Like I put my phone up. I didn't want to get too greedy or anything. And I checked back later, and it just kept on falling, and it just kept on falling. And then the news finally broke out. I finally seen what happened, and I'm like, wow. So here we go again. But tech stocks, which have been leading this rally all year, what we've seen fall the hardest. They've already extended. Everybody's kind of been wondering the same question, including fund managers right now. Is this a bubble that we're seeing, or at least entering? And Societe Generale, maybe I'm saying that right, maybe not, they're saying that this probably isn't a bubble, at least not yet. And the argument that they provided, they pointed out some points like the tech rally is profit driven. It's not just built on hype, it's backed by the profits, which are doing pretty good. So that's reason number one. The second being the capex boom and AI is being fueled by cash flow and not debt. A weaker dollar helps large US tech exporters, and monetary policy remains supportive with rate cuts still being expected later on down the road. But I mean, you can't deny how concentrated the market has become. So we see the top 10 stocks, it now makes up over 40% of the entire S&P 500, which is the highest level since 1972. And when you flash forward 20 years or so, 27 years or so, that's when around the dot-com bust, where a lot of people's comparing this time to then. So that kind of dominance, plus today's volatility spike, it just shows how fragile the market really is, and especially when those few giants have the possibility of slipping, what it could do to the indexes, which move with them just as fast. So meanwhile, we got the government shutdown hitting its 10th day in time, and things have really took a shocking turn. I mean, compared to history. So for the first time ever, the White House has begun mass layoffs of federal employees. Reduction in force notices went out across multiple agencies, including the Health and Human Services, Education, Commerce, Treasury, Homeland Security, even the EPA, and hundreds of thousands are still furloughed, but this is different. So past shutdowns never included permanent layoffs, just these temporary furloughs. There are already questions of the legality of these cuts that we're seeing, while the White House says, yeah, it's unfortunate. It's an unfortunate consequence of congressional gridlock. This is just what we have to do. So behind the scenes, they're also scrambling to find legal ways to pay some of the active duty military personnel using these leftover funds that they have from July's tax and spending bill, showing just how severe all of this standoff has become. There's a lot to consider and think about, including Social Security. So, and we'll talk about how that's tied in here in a bit, but the shutdown means we've also been without government data for quite a bit, and people aren't necessarily loving that. So pretty much where we're at is that they're trying to work on a way to where the CPI report that we get in nearly 2 weeks, we've been without government data for 2 weeks, but they're trying to make this exception so we're not without data forever. So some of the furloughed workers are being recalled back to release the September CPI report, like get back to work. And they're expected to, they didn't give an exact date, but the expectation is that October 24th, that we'll see this CPI report released around that time. And they're really trying to do this because of Social Security payments being tied directly to inflation. And without the CPI data that gets, and it's super important way beyond just the Social Security, but the cost of living adjustments can't be calculated unless we get this report. And then back to Social Security, that's not accurate or up to date or paid out. Whatever happens out of that. And one thing you don't do to senior citizens is mess with their Social Security. So what economists are expecting to see from the inflation print is to see it rise 0.4% month over month, 3.1% year over year, with core inflation being sticky at 3%. Service prices like shelter and healthcare, they're showing signs of early cooling, and that's exactly what the Fed has been waiting for. So we heard from Cleveland Fed's, I'm kind of mixing up my words. So the Cleveland Fed's nowcast model is showing that the numbers are kind of in the ballpark. So it was updated today. And when we scroll down to this inflation year over year percentage change, what we see is that the headline inflation is up 3%. And for core right here, you can see it where my mouse is, that is up 2.93% year over year. So even as this shutdown drags on, inflation seems pretty steady. It's not accelerating. It's not collapsing. It's just kind of holding around this 3% range. Now, this is what I kind of like started talking about a second ago. And today, in the middle of all of today's news, this was kind of clouded up a little bit. It said a lot, though, was Fed Governor Waller's interview with CNBC, where he stepped in with this rare dose of realism that I'd say we haven't heard from him, because he's really been a dove lately, and this is kind of him like backing off that dovish stance, which is an interesting timing for that. And in a way, I wonder if this hurts his application for the Fed chair spot. So he said that the labor market is weakening, and it's weakening fast, and that's what's driving his thinking on rate cuts right now. And he really wanted to underline and say hey, it's the labor market weakening is why we're supporting the cuts that we support at the Fed, not tariffs, not politics. So really reinforce the Fed being independent. You can't have negative job growth and 4% GDP growth is what he said, and he's saying something's got to give. So what he believes is that job creation has already turned negative and that CEOs aren't hiring, but while he supports these rate cuts, he doesn't want to move too aggressively and risk getting it wrong. So he mentioned that the Fed's on a path or a pace that he's comfortable with as far as these rate cuts. And I'm thinking about that, like what everybody's currently guessing the Fed's going to do. And it goes back to the Fed's dot plot that we got, which shows 2 more cuts this year, 2 or more cuts, but probably 2 cuts, which was probably what he was referring to when he mentioned the pace that they're being on a good pace at. But he also warned that the economy can't sustain this divergence where we've got this strong GDP on paper and in reality hiring is weak. So which one of those break first? And with all of today's chaos, I just wanted to check and see where we fall on the CME Fed Watch tool, and 98% chance on this 25 basis point cut in October 29th, December 10th. This one skyrocketed up 91.7. I think this was 80% something, 80 something percent yesterday. So it looks like 50 basis points is right on track. Maybe Waller confirms this is probably the path we take, unless we get other data that kind of influences that one way or another, but that's where we're at. And then lastly, we're on probably the most boring news of the day, consumer sentiment. So we got the University of Michigan's preliminary consumer sentiment index, and this came in at 55, pretty much unchanged from September's read, still near historic lows. We didn't get a whole bunch of new news from this. Inflation expectations dipped slightly to 4.6%. We've seen long-term expectations, they held pretty steady. Consumers are still nervous, but they're not panicking yet. So all of this is kind of old news. Spending still remains resilient while sentiment stays depressed. So we didn't get a whole lot revealed here, but today overall, we've been revealed to a lot. So just to kind of recap on what we talked about today, we got tariffs are rising, layoffs expanding over there at the government, at the White House, inflation data trickling in through a shutdown. We might see that here pretty soon. And the Fed trying to read this blurry dashboard. And all of this lands just as the bull market turns 3 on Sunday. So this is quite the happy birthday to the market. And just a reminder that markets can rise on momentum right until reality sets in and reappears. So that's where we fall today, literally where we fall. Check the stock chart and see where we fell to. But hope your day was awesome, hope your night is awesome, hope you have a great weekend, and have a good one.